podcast, everybody. Thank you for joining me. Today is December 10th. It is Wednesday, and pretty nasty out there on the markets today. And so we're doing a podcast just to kind of give you an update on what we're seeing, what we're thinking. So just to give a quick rundown, the Dow Jones finished down around 264 points. The S&P finished down about 33. The NASDAQ finished down almost 80 points. So generally about 1.6%, we'll call it, 1.5 to 1.6%. Now the Russell 2000 was down 2%. So again, threatening being negative on the year. So emerging markets down, pretty much everything across the board. And of course the big story, oil being down another 4% or so on oil. So oil flirting with that 5 handle, going to have a 5 in front of it pretty soon, it looks like. And that could be a washout at that level. So we'll talk about that in just a minute. Let's first take a look at the S&P 500. And you can see this uptrend that had been in place. Of course, we broke that in October, got back into it. But here's the thing I'm seeing, and it could be some concern, is we're not seeing the trajectory the same. So in other words, this high didn't get up to the existing high, so that may have been a warning originally about October. But then we've come back, and now again we haven't gotten back up to this high. So this trend could be starting to flatten out. Where you're getting something, you'll have to pardon my my drawing here, but I'm going to try to draw something for you. But you're kind of getting this situation with it's going up, and then it's just now starting to flatten. Are you starting to get this beginnings of a rounding over of the overall stock market? So that's probably the biggest concern. But if we take that off for just a minute, let's take a look at where we are. We're obviously at the bottom end of this trend. You know, if that's all we got, then you're talking a 2% pullback. And certainly it feels like it may be a little bigger than that. I think some people are watching this 50-day moving average, which would be right around S&P 500 being at the 2,000 level. So that's another possibility. Another possibility here would be this inverse head and shoulders where, you know, we dipped, we came back, we dipped much further in middle of October, and maybe we come back down to, let's say, even the 200-day moving average. So you're still making higher lows from the October level. But if we do that, you know, you'll be looking at a pullback that's going to be somewhere in the order of about 6%, and that could be the case. And the question I'm getting is, is this? We're obviously seeing some recessionary trends around the world. Is that going to bleed into the U.S.? And there's no question that there's a bifurcation in the market whereby the U.S. Better jobs report Friday. U.S. is still the best house in a bad neighborhood. Things are still improving here, and you've seen it with the U.S. dollar improving, and so money is flowing into the U.S. This is ultimately going to be good for the U.S. The problem is that you have oil, cratering basically down to the $60 level from just 110 not long ago, and that's going to change the whole, obviously, Texas economy. Most of you guys are in Texas listening to this, watching this, and that's going to affect the Texas economy pretty quickly. And then at some point, rigs start to be laid down, and so plans change, layoffs at big companies. So that's something that, again, it depends on how far oil goes. It also depends on how long it stays down at those levels. That's another key. If it bounces right back, because who's to say OPEC isn't like the Fed and changes their mind quickly, right? But who knows? But who's to say they don't say, well, yeah, on Thanksgiving we said that, but now that oil has fallen even further, we are actually going to cut. So we don't know, but there is, and this isn't updated through today, but this is the picture of oil here. Of course, had that big bounce yesterday, but if we were to look at it intraday, it's down to about $60 here. So we're getting to a level now that it's there's definitely panic. We've definitely broken the uptrend that was in here. We broke the other support here at the $80 level, and now we've broken the support at the $70 level. So, many people are calling for $40 because that's where it first broke out after the financial crisis, was around $40 a barrel. So you're talking, another 33% down from here. I think if something like that happens, it's not going to be a straight line. We're at the point now we're much more oversold than we were even in the 2008 financial crisis. So there at some point here, pretty soon, I think you're going to see what you would call a rip-your-face-off rally in oil that's going to reverse. It may not start until the new year. because nobody wants to be showing that they own oil stocks coming into the end of the year. But you could see it in the first part of January that you see this very violent rally that takes us back up. But again, that doesn't mean that the downtrend is over. If you're looking at this kind of like a stock chart, this doesn't mean that we couldn't see a bounce only to see it fall further. So hard to say where ultimately oil goes, but there will be a floor. But that's what makes some of the energy stocks difficult to analyze, because when you take a look at energy here, it's a moving target, isn't it? The prices are changing daily. You don't know what these companies are planning to do. I don't think they know what they're planning to do because it's such a fast-moving market. So it's hard to say, well, it's cheap, let's go ahead and buy it. I don't think you can do that with those. But I think if you have some other things in the portfolio that either are working or aren't as volatile and you can afford to stay in those, fine. If you don't own them, do you take a stab at them right now? I'd say if you have it in an aggressive strategy, you perhaps do take a stab at those. Even if it's a third of what you want to do, take a stab and you can average down. There's going to be a big violent rally like there was in the middle of October. Again, but that may just be a trade. It may not be a long-term investment. It's hard to make a long-term investment in some of these given that the dynamics are changing so quickly. So you have oil selling off, issues in Asia, or excuse me, in Asia too, but you have issues in Europe, and they're begging for quantitative easing. But the way it looks right now is that when you look at the stock market, right now what's been happening is it looks like passing the baton. They are threatening to do more quantitative easing over there. The Fed's threatening to raise interest rates over here, and many believe they are behind the curve and they should be raising them right now, but they are so scared of how investors in the bond market would react, so they're not doing it. But you are seeing definitely money moving into the U.S., into the dollars, and into treasuries right now. Out of 80 economists that were asked at the beginning of the year if they thought rates would be higher or lower, all of them said they would be higher, and they've all been wrong. And I thought they'd be higher, and I've been wrong. Again, do you want to go buy a treasury bond right now? Many people believe that rates may rise. Here's a picture of interest rates. They may rise, but are they going to spike up to 3%, 3.5%? They don't believe that. A lot of people believe they're going to rise, but they're going to stay, somewhat of a lower level. And so, there's this kind of barbell approach where people are still buying treasuries, especially because our U.S. dollar is going up. So anyways, getting back to the stock market. So that's the S&P 500, which again is only a little part of the story. If you look at the Russell 2000, very volatile the last few days. Had a big up day yesterday and then down 2% today, kind of hanging around the higher end here. But we could see that certainly start to fall apart as well. If we take a look at gold, the gold's actually had a nice little run. For the first few days of November, but basically part of November, it did pretty well. But again, nothing has changed as far as this potential downtrend and the U.S. dollar. So U.S. dollars had a little profit taking here recently, but it still has a lot of reasons why it should continue to do well, which is going to put pressure on oil and gold and other commodities in general. Take a look at the VIX, up 23% today. It's not quite to my zone of, hey, the coast is clear, but today was probably the first 90% down day we've had since October. We get another one of those, and the VIX pops up a little further, then you've got a tradable rally. And then again, the question is, how do you want to handle that? Because if you want to make a trade, it'll be a good time to do that, to buy some stocks for a trade. But that doesn't necessarily mean the investments are there. And I think, if you're wanting to know how to handle this market, I think the best way to handle it is to break your portfolio overall up into different pieces. So your longer-term portfolio, nothing has changed in the last few days, and you have to have systems in place. And so, we've been trying to stay in some of our rotation type things. We've been trying to stay in financials, which, were hurt today, outperform the market, but they've been doing very well recently. So we've been staying in things like that, the overall, large cap stocks, and then healthcare. Healthcare has been doing extremely well as well. So those are the things you want to stay in, but there's nothing wrong with taking a stab in some of these beaten up energy names. There's a lot of people I know trading them. You can do that. But if you break your portfolio up into these longer term positions and say, look, I'm going to have a system in place, a lot of those things haven't changed. But the tactical nature, there's a lot of things moving right now, but it's just not pretty overall. There's a lot of stocks already in bear markets, And so if you're wondering, or are you getting extremely defensive right now, the answer is no, I'm not, because I'm trying to let this play out. If you would have gotten extremely defensive in October, you saw what happened. It rallied back, and it rallied back hard, and that could easily happen now. And by the way, this is only, if you take a look at the S&P again, this is only a couple of days here. So, we could have further to go, but you have to worry about this kind of V-bottom again, because we've got seasonal factors. We've got the Fed that could say something that the markets would rip-roar on. We've got Draghi that could say something the markets would rip-roar on. So you got to be careful about being too defensive, but you need to let some of this volatility play out. But at some point, you have to have your systems in place to go, you know what, I'm willing to put up with a little bit of volatility, but there's going to be a level at which you start to liquidate positions. And we're not quite there yet, not after a few days of this. So, but definitely the oil market is still the thing that's causing concern, because it's going to affect jobs. It's going to affect the Texas economy. And just the overall market's looking at this saying, wait a second, is it just that there's too much supply, or is demand destruction happening? And a lot of people believe that's a sign of the overall economy. The other thing to watch is junk bonds. High-yield bonds had another bad day today, down about 1.2%. So this isn't a pretty picture, because this picture here typically coincides with what the stock market looks like. So you've got this divergence right now where these are going down, and the stock market is, or was up until today, still going up for the most part. So this divergence, and you got the stock market kind of doing this, that needs to be resolved somehow. So watching that, and then again, people are moving down the risk scale. As I mentioned, about half of the Russell 2000 is already in a bear market. So Russell's underperforming the S&P, junk bonds underperforming, and this is nothing we did. We've seen this for a few months now, haven't we? But the stock market hasn't cracked yet. So this isn't necessarily saying things are falling apart, but it's certainly signs we need to pay attention to. So make sure that you're doing that, and again, have your systems in place. But don't let a few days of volatility spook you out and get you over trading. The things that typically fall the hardest are things that are going to bounce the hardest. So you have long-term convictions on some things. You've got some things you trade on, and also don't be afraid to short. We are still short utilities, which is close to getting a stop, but had a good day today for short. They were down about 1.3% after reaching this kind of double top. This is the most one of the most pricey areas we see. The what's happening right now is, and again, it's how far are they away from their 200-day moving average. So here's the 200-day moving average. They're way up here. When they get that far apart, you tend to see the market pull back a little bit, and that's what we're thinking that's going to happen, is that they're going to pull back. So we're not calling the top in utilities, and we may be stopped out of this trade. It's in our tactical aggressive allocation. But the point is, this, I think the bigger picture is this income trade that people have been forced into is going to end at some point, and it could end pretty badly. So you have people that are typically own bonds and CDs, and they're owning utility stocks because that's where they're getting their income from. And when that ends, you're going to see some of these get hit really hard. Another area of why I think junk bonds are selling off is because a lot of the junk bond market is considered is energy. And so you're seeing a lot of problems in the energy markets right now with junk bonds. So again, take your risk down as far as your overall big picture risk. If you're safe for money, it needs to be safe. If you have aggressive money you're trading in, that can stay aggressive and trade because that's what it's supposed to do. So you have to break your portfolio into these different buckets. And there's going to be some opportunities in a lot of stocks because there are some stocks going down right now that aren't justified to be going down. But we are starting to see that indiscriminate selling the last few days that we saw, back in October. This was indiscriminate selling. And but again, we're closer to some of these things peaking as far as fear than we were back when it was at this level back over here. So it's been interesting. Fear's actually been picking up the last few days, even though markets only pulled back a little bit. So, all right. Again, if you'd like to reach out to us, it's eggerscapital.com. We are also, telephone number is 210-526-0057. We're on Twitter. @Carl Eggers is my handle. And you can always reach us on iTunes, Google+, Facebook, all of that stuff. So have a wonderful evening. Keep the questions coming, and we will talk to you soon.